Hello, let's look at question 21 from chapter 11 of your tax book. And this is in regard to an investment in qualified small business stock. So David has a choice. He could either buy Fortune 500 company or his friend's small business stock. And so the question is, if everything else was equal, and that's very important that everything else would be assumed to be equal, because again, it's not just tax issues and characteristics that we need to be concerned about. It's earning power, it's risk, etc. So if everything else was equal, which of the two would David prefer to invest in if he intends to hold the stock first for 6 years or if only for 2 years? So if he invests in the stock of his friend's corporation for more than 5 years, then all of his gain is excluded. Now that is different than what's in your textbook. There is a note in your textbook that the amount that might be excluded could change depending on a change in the tax law, and that tax law did take effect. So when you have a qualified small business stock investment and you own it for more than 5 years, then you will not have to pay any gain when you sell that stock. I'm sorry, you don't have to pay any tax on the gain. You don't have to report any gain. But if it was only to be held for 2 years, well, that might change the situation drastically, because it wouldn't really matter if everything else was the same and he did not qualify because of the 5-year period for the 100% exclusion. He'd be paying tax on the gain, whether it's his friend's stock or a Fortune 500 company stock. The next section deals with wash sales. And with a wash sale, the taxpayer would like the best of both worlds. And what happens is, when an investor has several investments in stock, and he or she knows that the stock, a particular stock, for example, has decreased in value, if they sold that stock, it would generate a capital loss. And so they may want to generate a capital loss to offset some of their capital income. And what some taxpayers have tried to do in the past, and have done successfully until the wash sale rules were enacted, is they would sell that stock, recognize a capital loss, be able to deduct it on their current year tax return, and then they turn around perhaps that day or the next day or very shortly afterwards, and they would buy identical stock at that low price and then wait for it to grow and then appreciate and then sell it at a capital gain. So in either situation, whether they sold it and repurchased it or just hung on to that stock, that gain would have occurred over time, but the benefit is that they were able to take a capital loss deduction in the current year. And so what the wash sale rule did is prevented that from happening. So if a taxpayer purchases the same stock or what's called substantially identical stock to the one that they just sold at a loss within a 60-day, 1-day window or period centered on the date of the sale, then they cannot deduct the loss. That loss would be added to the basis of the stock that they repurchased. Now, this first paragraph, or this first section on this new page, says that a wash sale occurs when you sell or trade stock at a loss and within 30 days either before or after the date of sale. That's important. You could actually buy some new stock first and then sell at a loss. That's still considered a wash sale. So it's 30 days before or after the period of that transaction. So it's a 61-day window, including the middle day, the day that they actually sold at a loss. And so again, what happens is they cannot deduct the loss. They just add it to the value of that identical stock that they purchased. That deters taxpayers from selling the asset, recognizing the loss, and then replacing that stock with identical or substantially identical stock. Question 23. Nick does not use his car for business purposes, meaning it's a personal use asset. And what happens if he sells his car at a loss? Can he deduct the loss for taxes? And the answer is no. A taxpayer must report income and pay capital gains on the income if they sell a personal use asset at a gain, but they are not able to deduct the loss. Now that's one situation that is not to the benefit of the taxpayer. 24. Describe 3 tax planning strategies available to taxpayers investing in capital assets. Excuse me. When a taxpayer holds capital assets for more than a year, you use 2 basic strategies. First, you defer recognizing the gains, and that reduces the present value of the gains tax when you do sell it. And second, because holding it for more than a year converts that into long-term capital gain, you get a preferential tax rate depending on which tax bracket you're in. We already discussed that. The third strategy is to sell investments with built-in losses. So if you do choose to sell those assets, like we talked about with the specific identification method, for example, you choose which assets to sell because you know that they will sell at a loss, and so then you can offset your ordinary income by up to $3,000, because remember, once you net your capital gains and losses, any net capital loss in excess of capital gains can offset ordinary income by $3,000 a year, and then you would carry over any remaining losses to future years. Question 25, Clark owns stock in BCS Corp. He purchased in January of the current year, and it has appreciated during this year. Now, less than a year later, he's deciding whether or not he should sell it. So what should he consider, both tax and non-tax factors, if he wants to decide whether he should sell it now? So the answer here says that Clark should consider the rate at which the gain will be paid, or will be taxed. Because it's short term, it would be taxed at ordinary rates. If he holds it beyond 1 year and sells it sometime after the purchase date in January the following year, he can enjoy the benefit of long-term capital gains rates. So those are the tax considerations. The non-tax considerations are here. I'll highlight those for you in yellow. And it says Clark should also consider the risk that he might lose some value, and also he should assess his other capital gains and losses during the year. And so remember, he could net that loss against other gains. And so, the non-tax is here. And that's about the value declining. If the value drops, then that wouldn't be a good thing. So it wouldn't make sense to hold on to an asset just to make it long-term so that you can have long-term capital gains, while at the same time perhaps losing some value so that your gain wouldn't be as large as it could be if you sold it now. So there is much more to think about than just the tax consideration. 26. When would you expect the after-tax return from an investment in a capital asset to approach that of tax-exempt assets, assuming equal before-tax rates of return? And that would be a very, very long holding period. So the longer you hold your asset, the less the tax cost, because by the time you discount that to present value, there's not going to be much of a difference. And so the longer you hold it, the closer the after-tax return from a taxable investment mirrors the tax-exempt investment return. 27. Why does the federal government exempt municipal bond interest from taxation? And it's basically what we've learned in Chapter 1, because they want to promote or encourage investors to loan money to the government. And so also the tax benefits associated with municipal bonds means that taxpayers are willing to accept less interest income, a lower rate, and so the governmental units save money. Why do taxpayers have an incentive to purchase municipal bonds from within their own states? Because typically, if you buy bonds from within your own state, not only are you exempt from federal taxation, but also from your state income tax. 29, I'll just gloss over. What's the implicit tax? You may recall from Chapter 1 that I didn't cover that much. It's just really saying what I alluded to earlier, that if somebody is going to invest in a tax-exempt bond or tax advantage investment, they are going to have to expect that they won't earn as high of a return. It's just kind of inherent in that. And so it's considered an implicit tax just because their earning power is lessened. How do taxpayers' explicit marginal tax rates, that means their real marginal rates, affect their decision to buy municipal bonds? Well, you have to look at what you're going to earn for municipal bonds with the after-tax rates from the other taxable bonds, and we've done that very early in this semester as well. And so if you have a low marginal tax rate, then you're not really paying too much income tax. And so taxpayers with low rates prefer the explicitly taxed investments. In other words, I'd rather earn a higher rate of interest, for example, on a bond when my marginal tax rate is low, then I'd want to earn a lower rate of return on a tax-free municipal bond. 31, who are the natural clients for municipal bonds? Taxpayers that have high marginal tax rates will choose to earn less interest as far as the rate because they save a large tax bill. So it's the high taxpayers, the high marginal taxpayers. Number 32, how can we view life insurance as an investment? Well, some policies allow a buildup in the cash surrender value, so you're investing money to pay for insurance premiums, but you're also building some value, kind of like a savings account within the policy. 33, how are life insurance proceeds taxed when paid after the insured individual's death? They're tax-free, which means tax exempt. 34, how are life insurance proceeds taxed if a policy is cashed out early? Well, the only way you would get the benefits from the life insurance would not be the death benefits, but the cash surrender value, and that's taxed as ordinary income as received. 35, list the important non-tax issues when purchasing life insurance. Well, there are high fees to buy that insurance policy, such as commissions, and so it might not be the best investment for earnings potential. We'll stop here.